Okay, hello everyone. Welcome to this week's Intervening on the Market Weekly Report, May 2nd, 2026. I'm actually recording this a day earlier than I normally do on Saturday instead of Sunday. This is brought to you by Minervini Markets 360, as we do each week, and of course, Minervini Private Access. Real quick before we get started, I want to just go over a new platform feature and also point out how to enable it because some have not been able to see it on their screen because you have to enable it. It's the VCP score, which is in your screening. You can open up these VCP screens. This actually says VCP 300, but we have a VCP 400 now. It's going to give you the 400 top names for stocks $8 and above, TPR A, B, and C that are ranked in order of how well they're setting up VCP patterns. And then, of course, there's the below $8, and then there's the ETF screen. So you can not only can you bring these up in your screening, but you can also enable them anywhere on any of the spreadsheets throughout the platform. So either one, you have to go over to your columns and you open this up. That you can access that by opening the whole screen up on whatever module you're in, and then make sure that score is checked, and then that will bring up the score, and then you'll have to move it to where you want it, and set that up, and then that score will rank that. And of course, so if you have a watch list or something, you can sort it by score and see how those stocks are setting up, or you can run purely just go to the screen and that'll bring up the top 400 names. It's automatically ranked from high to low within that. Now, keep in mind, like I pointed out before, it doesn't necessarily mean that a 95 is better than a 45. Um, According to the computer, it is, but you really have to go in there and take a look because the top 300 or 400 names could have some names that are ranked very low, but they're still have pretty decent setups depending on how many setups are available. Um, uh, but again, you'll see there'll be much more in the top one third than there is in the bottom one third, and a mix in between in the middle one third of those of that screen. But I would go through and just go through and look at a couple hundred names to look for potential buys. Okay, let's start off with key components of market health. I'm also going to go through some individual stocks at the end here, and go through some of the recent purchases. So do that in just a second. But let's look at the general market as we do each week. Major market indexes, obviously they're extended, they've run up, but this is a lockout rally where that's what you generally get. And as I pointed out before, we may not get much of a pullback. A lot of people waiting for a pullback, and some are even calling for a retest of the lows. I don't think that's probable. Up down volume is now neutral because we have seen a little bit of battle back and forth between some distribution days and some accumulation days. I'll point that out in just a second, get more specific on that on a chart. New highs, new lows are still bullish. Individual stock participation is definitely extended. We've got a lot of names that are extended. However, there's been a very a good number of there's been a good number of names that have been showing up. And again, that VCP screen will show you the stocks that are set up in bases. So there's been an ample number of names to choose from for potential buys. And so I would say that it's a mixed situation here where we do have an extended market, but as long as there's viable names, you don't get too myopic and worrying about, there's some names that are extended, so you're not going to buy other names that are setting up. This may proliferate for a while. You just don't know. So you got to just take the pitches as they come across the plate. And right now, we're still seeing some. Sentiment is neutral. Long-term sentiment is a concern. Shorter-term sentiment is neutral. That's another thing I'll go over in just a second. If you remember last week, I talked about how the market believing Trump, that he wants the war to be over and that oil prices may be elevated, but the market is saying we're not too worried about this thing, betting that the worst is over. For a minute there during the week, I thought that maybe that was the market changed its mind and we started seeing some pivot leakage. I call it pivot leakage, but you can't get too panicky too quick from just one day or 2 days. Sometimes you get a couple days of shakeout, and it actually strengthens the situation in these individual charts, and that is what happened in a number of cases. You're going to see, this conflict is continuing here, and the rhetoric is from day to day sometimes is much more than others. But again, we're not seeing a recession. We're not seeing real big inflation here. The economy is strong. It's in the Goldilocks environment. Another chart I'm going to show you in just a second. Oil prices have moved up, and I was expecting the market to be affected more, and it's holding up. And who knows? I mean, if they break out into new highs and things really start to get hairy in the Middle East, I'm sure the market will pull back and it will cause a volatility. And that's probably why we do still have a bit of elevated volatility. But again, the market's been holding up really well. I mean, we're looking at 1, 2, 3, 4, 5 weeks up now in the S&P, and it has put the S&P and the indexes into an overbought condition. We are seeing a little bit of divergence here too. That would like to see a little bit more strength beneath the surface. One of those divergences are the percentage of stocks from the S&P 500 that are above their 50-day moving average. You can see it's just a little above 50%. And we move real quickly. So that sometimes can happen when you move really quickly. But when you get overbought and you get a divergence like this, yeah, a pullback is likely. That doesn't mean that it's going to pull back stocks to the point where they stop you out, or that you're not going to have setups, you're not going to have breakouts. Sometimes during a market pullback, you get the best environment. We did see a tug of war a bit. Depending on the index you look at, we look at the NYSE and the NASDAQ. The NYSE had a really impressive day on Thursday. You can see up on volume, real good net progress. And prior to that, we had some distribution. It was starting to look a little bit starting to look a little bit ominous. We got the follow through day, had a little distribution day, which was immediately corrected with another accumulation day. And then there was that pretty good sized distribution day right here. Volume wasn't above average. So that was one of the things, one of the bright spots that I grabbed onto. But then you started having these little distribution days and it was drifting off. It was looking fairly natural, but you don't normally like to see distribution days after you get accumulation days. And the antidote to that is accumulation, very quickly, and you want to see the accumulation bigger in price movement and in volume than the distribution, and we got that. Nasdaq's been pretty much just running up, and the volume characteristics have been similar, but that also has gotten to a state of being not only overbought, but there is somewhat of a divergence there where you're saying only about 42% of stocks are above their 50-day. Now, I'm sorry, their 200-day. This is something that has really persisted for the almost the entire bull market, and probably even going back a little bit further. It's really been a very small participation of names in the Nasdaq, and that's just a symptom of, and this might even be why we're seeing it in the S&P 500, because these indexes are weighted and there's a small number of names moving them. So I think there's really been a decoupling from what they're representing, and it's almost like a false representation of the overall market. So you got to take that with a grain of salt. But what we do see is, if you look at the cycle work and the composite for this year, for 2026, yes, it was supposed to be bullish. We got it all at once. We were actually diverging. It's funny how the cycle work showed us that we were supposed to go up for those first few months, for the first quarter, and we literally went in the opposite direction. But then it righted itself, if you will, and played catch up. Now, the cycle work going forward for an extended period of time is saying down to sideways. So as we get extended here, I think again, we're probably going to have some type of pullback or consolidation. When you look at the Nasdaq or the S&P, S&P same, really a sideways market from this point forward. So again, going into a period where we should expect maybe some pullback. Now, that doesn't mean, again, I'm going to point this out again. You can have a sideways market. I actually like the markets that are mildly pulling back and are more sideways to maybe slightly up. They're orderly, and you sometimes get a lot of breakouts, and a lot of stocks give you opportunities to make money, even though the market may have already run up. So I would not shy away from buying buying new breakouts coming from pivot points out of bases. Now, the real story behind the market for a sustained bull market is not in oil shocks. It is not in Middle East crisis. It's in the U.S. economy and how it's being affected, and the Goldilocks environment is precisely what creates sustained bull markets. And you can see if you go back, I've shown this many times, but I'm going to keep showing it because we want to keep a reference point of when we break out of this type of environment, that's where we're going to see a much bigger problem in the market. And you can see from the 1980s where we had that very tight range of GDP, of real GDP. And again, you have recessions from time to times, and you'll have dips, but it's that keeping that pretty tight, moderate, sustainable growth is what can keep the market going. Because if you have inflation, if you run up in high inflation, well, then the Fed has to tighten, and obviously that could lead to a recession, and then you've got these wide swings in the economy, and that's what the market doesn't like, and that's the environment we got into when we topped in 2000. We went sideways for a decade. And that's where you see there's much wider swings, and you're really not grabbing onto any period of time, except you had a cyclical sort of bull market within this secular sideways market consolidation, or a bear market, if you want to call it, for all that time. But then we went to lower lows, of course, and it got pretty bad in the economy, and that bottomed us out, set us up for this next bull market. So now, how long this is going to go, don't know, but it's been going for a while. So that's why we want to keep our antennas up for when this changes and when the market tells us that we're starting to see the precursors of a cyclical bear market. A major surge in oil certainly is one that could cause a recession and can cause temporary inflation. But other than that, we're not really seeing a whole lot. The ECRI weekly leading index has been showing, and this is along with a lot of other indicators that have basically raised the red flag of a recession. And we, again, like I said, we want to be respectful of this. If we get a downturn, we see credit conditions start to deteriorate, and we get a downturn in the long-term trend in the market, I would respect that and go to cash. But we have not seen that. Credit conditions are still in a good place. I measure them in a bunch of different ways, so we haven't gotten that. Sentiment now has improved. We moved more to the neutral now. We're looking at here at the investors' intelligence percentage of bulls. We were very bullish, and we're at areas that where we look to sell into when we're frothy, and then we came down to a much more reasonable level of bulls, which were some pessimism at that point, and now the ratio, we haven't turned back up to those highs, and we're a good distance away. So short term, that's fine. We don't see any problem there. Longer term, as I pointed out, and this is something that I heard, I think Druckenmiller talked about it recently, and Paul Tudor Jones has started to talk about this. I've been talking about it for a while now, and just something to be mindful of. That we have a large percentage of household assets that are in stocks. So, do we want to stay away from stocks? No, because we don't know how long this is going to go. But when we start to see the unraveling, and this something that we saw, one yellow flag that was thrown was the downturn in the margin debt. Although this could turn back up, and we might have to get to more extreme levels, as you can see back in the 80s and 2000, and even back in just after 2020, we had much higher levels of margin debt. So it turned down from higher levels. Uh, so we may turn up from here and have to have a blow off. So that's why we don't want to get too panicky here. The S&P 500 model, our S&P Advisor model, is your best barometer of when you should be moving into a really defensive posture. And that is if that goes to a sell signal and starts raising cash, that's where you really want to respect that. I've been talking about that for a while, and I hope when that does happen, that you do raise cash and you do go into a defensive posture. But right now, still 75% invested there, and could go to 100 if we continue to hold up here. STEM model is a cautious exposure. It's good enough. The conditions are good enough to be active, and if you are doing well, you should be strongly active. Um, sort of in an easy dollar environment. If you're in your own easy dollar environment, then great, but I think overall, we're looking at overall the breakout environment and what's happening. I think we're in that middle sort of, yes, it's good enough to have exposure, and if you're doing well, you can increase it. Certainly not a hard penny environment, not at all when you're hitting new highs in the S&P 500 and you've got a bunch of stocks setting up and breaking out. However, is it this a real easy pickings market? I wouldn't say so, but I'd say it's pretty good. It's pretty good, and it might even get better. So let's take a look at what's happened here and some of the breakouts that have worked, and a couple that still the jury is out. Something like a Micron, and here's the thing, we hear people all the time. I've been hearing it for years and years, and usually it happens, when obviously when there's a difficult trading environments, breakouts don't work anymore. It's too many people are doing it. Well, first of all, at some point that does become true temporarily, and then they work again, and then they don't, and then value works, and then value doesn't. And so every dog has its day, and that's part of it. But the mere statement or the mere thought that breakouts don't work, especially that they're not working, is absurd because not only are they working, but they're working in the biggest, most random names that if they weren't working, these would be the stocks that they really wouldn't work well in, and that's the Microns and the Nvidias and things like that, Google. So we got a breakout in Micron. This is textbook, so far, and I don't know what's going to happen going forward. But certainly, this is a textbook breakout. You've got the volume came down very nicely, nice little above average volume on the breakout, very shallow pullbacks here, acting really, really well. If this is the type of situation where you can de-risk with a small percentage of the position and still hold to that stop and have no risk whatsoever. Google, another situation where the implied volatility going to earnings was only about 6%. Our stop was about 6%. We're up a little bit on it, so that was enough to go into earnings, and we got a nice pop on it. Textbook breakout, absolute textbook breakout. Once again, from a big cap name. Even Caterpillar had textbook action where you broke out here. You had a very orderly pullback, and this is what we want to see. This is clear tennis ball action where you pull back for 4 or 5 days, and then in one day, whammo, you erase it all, and you're back into new high ground. And that also came on earnings. Um, Something like now, of course, there's other names that aren't these big, widely followed names, and some don't even have very big earnings, whether they're biotechs or medical device companies. NKTR is one that we bought off of another very classic VCP, tightened up here, got a nice pop on it, sold some, backstopped a little bit. Now we have a small position for a bigger move, but this is what we call the gift. When you get a big gap like that after you buy it, usually, we're going to take some profits into that. A couple that still have not yet to make any headway, but again, classic action where you get the pullback buy, you squat, and then the next day you get the reversal recovery. And so now again, the jury's still out on this, but the classic setup. You got the low cheat right here. It came up in a little gap. You got a cheat right here, and then you got a handle. So this stock stopped at all the floors. So, the elevator stopped at all the floors. Your first buy could have been a little bit right here. You add here, maybe get a little more aggressive, and then finish it up over here. Um, Something like TKR, another one, classic. You didn't get really a bottom fishing cheat there, and even this cheat area right here had a little bit of volatility, but then it tightened up quite nicely, and then on Thursday it came out of there, pausing a bit. It might tighten up a bit more. If this tightens up a bit more, that's an improvement, and then if you haven't bought it coming out of there, you want to be even more aggressive, or add to it if you've only started a position. So now we got something like a KMT where we started it right here. It tightened up. And now this was part of the group that was starting to get some pivot leakage. Some were much worse than this. I saw some that were outright pivot failures, a couple maybe even base failures, but it didn't get widespread. And this is here where you're now trading near the danger point, and you want to see them put the running shoes on and get above this area right here, this pivot zone. So the jury's still out on here. If this can hold up and break out, one that if you're not in a full position, you can add to, and if you haven't yet bought, you certainly can buy it there. Now, we get a lot of questions about adding to positions, and I just had a couple questions actually on Twitter about adding up. in an O'Neill fashion, which I know a lot of people actually misconstrue the way O'Neill did it, and also David Ryan tends to pyramid up a bit, but they're not chasing the stocks up, and we're buying additional buys within the base from additional pivot points. So this is a perfect example. We start this here on the little pullback buy, anticipating it breaking out, but it needed to tighten up for another day or so. And then finally it comes out, and that's where we add to it. But you see, this is actually improved. Look at this. See, this is a little mini VCP, one, two, three, within the larger. That's what we call a fractal, a pattern within a pattern. We'd love to see that. So a couple of things here that's really classic. One is where you get the first buy, and then it needs to tighten up a little more. Then it breaks out. Then you get the little back step where it takes out the previous day's low. You get a little shakeout, and from there, boom, turns around. A day or two later, you get the reversal recovery. So far, everything is just classic here. Now, I'd expect maybe some pullback or a few days up, and then some pullback, and this stock to continue. If it doesn't, obviously, then we start looking at to see what the abnormalities are, and that's where Monalert is a great tool for that. Same thing here with Madison Square Garden Sports. We bought some here. Probably a little impatient on that. Maybe should have waited. And then, sure enough, what we needed to see, it got tighter here. And then that was actually a better buy point. And then we added right there. Now you could have even added here. That was another point maybe to add there. And then we got this natural reaction. Sometimes natural reactions sort of sit right on top of the breakout or even undercut it a bit, and you're at a little bit of a loss or right around break even. That's okay. If it doesn't take out the stop, let it base, let it go flat and see if it can recover. So right here on Thursday, if you owned it and you're still not fully exposed to it, that would have been the day where you then could add to that position as well. One last one is AEHR. Some people had some questions about this. This is a power play where you make a big move, you double in 8 weeks or less. And when we pull back here, if we pull back around the 20%, 25% range, I like to see the 20% range at the close. Sometimes we'll give it an extra 2 or 3, 4% on the intraday. If we can form a little pause there at the bottom, we call that a bottom fishing pivot. We'll fish it right off the low on a power play, because these are, again, as the name says, powerful. And again, that's really trading right at the danger point. Like it shouldn't go any lower. That's it. 20, 25% is where you should see the support if it really is that strong, and you'll generally find support. And then very often they'll mark themselves up. You might get a cheat or a handle. So we might get an additional spot to buy this. So a lot of times we'll buy a half or a quarter position and then start trying to build into it. You can be more aggressive if things are working. Go right to full position right off that spot. That's not unheard of for us. We do that at times too, especially when things are working. All right, so let me real quick. I want to talk about earnings real quick. Next week. So the week has a number of earnings on the 5th. One, two, three, four, five names on the 7th and on the 8th. So we've got a handful of names coming out with earnings next week. Have to be cognizant of that. Real quick, just to summarize, very impressive resilience in the market, uh, and classic lockout rally. We are extended. That's a sign of a lockout rally. You get extended. You don't pull back much. A little bit more volatility than you would normally see in this type of lockout environment, but that's been driven by news, which is being driven by the Middle East and oil prices. And we do have that event happening, and everything's revolving around that. So I would expect this to be a higher volatility environment. So I don't think that's unexpected, but the flow of setups is good. You have to base it though on your own trades and the feedback that you're getting from those trades, and that lets you know what type of level of aggression and exposure you should be having in your own trading. And when you finally get where you're getting your feet on the ground there, great, you can step it up, but keep it in relate it to your own traction, not my traction, not what you read about, but what's happening in your own portfolio. You really want to make sure you wait until you're seeing it in your own trades. And that's it. This is a very classic setup. I don't see anything really strange about this, as I pointed out before, and it's certainly coming to fruition. Exactly like I said, these oil price shocks and skirmishes and conflicts generally have good stock prices down the road. You get a reaction from them, and 3 to 6 months later, stocks are higher. And that's what we're seeing here. So keep your eye on the ball and try to stay away from the noise and the rhetoric. And I'll see you on Monday morning at 11 o'clock. Is it 11 o'clock or 11:30? 11:30, right? Yeah, 11:30. Sorry about that. 11:30 a.m. Eastern Time for live Q&A with myself, Mark Ritchie, and Bob Weissman. Hope you have a good rest of the weekend. All right. Bye bye.